Good evening, all. I request everyone to place their right hand on their heart and request office to play ICI Boto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता
Good evening, all. My chairman of the WRC, your chairman of the WRC, and our chairman of the WRC, CA Saurabh Ajmera ji, who is believing in inclusiveness, empowerment, and impactful as well. With the vision of our chairman, today's webinar is arranged because he believes that Go Global has to be there. It is the initiative of the WRC under his leadership, and under his leadership, currently there are more than 4 programs are going on today itself. So we salute you, sir. We admire you for your such a energetic and power pack, I can say, working for the membership and student at large. So I request our chairman, CA Saurabh Ajmera ji, to address all of us. Over to you, sir.
Thank you, the Dynamic Secretary of WRC, CA Vishan Shah, who is always available for all the programs and all the initiatives of WRC. We do have Vice Chairperson of WRC, CA Rikin Patel, who is leading for all the digital initiatives. And today we can see that our app is also working in terms of WRC Connect, and the intuitive experience which we are getting on website, it is just because of the initiative of our Vice Chairman, CA Rikin Patel, who is taking lead in so many ways. And then we have our Senior Regional Council Member, CA Sweta Jain Madam. Madam, thank you so much for taking leads for such a wonderful program which we are hosting at WRC. And today we have, in terms of faculty with us, here Ajit Jain. I welcome you, Ajit ji, for a wonderful program at WRC. And I can see the participation over there, and my compliment to all of them for joining for such a wonderful program where we are going to discuss about the arm's length architecture in the transfer pricing, which is at most important while going for the any TP audit and TP assignment. This is really required in all the manners, and there are a lot of intricacies which we have to understand from our expert. Furthermore, as I rightly highlighted by Vishen Bhai, that we are having today more than 4 programs which we are hosting at WRC headquarter as well as virtual programs also. And I'm very happy that since morning the show is going on in a different way. We have started our session on charitable and religious trust. Then we are having conference on investment banking, and we are also discussing for HNI families and their working related to CA practice, which is also a very important area in terms of highlight. So WRC is planning power pack sessions in terms of empowerment, engagement, and elevation of our profession, where we can provide some intuitive experience to all our members. Now, as I'm representing into 75th year of WRC, it is a greater responsibility on my shoulder to represent to all the stakeholder in a different way, and that is why we have come out with very unique initiatives and programs, which is very, very important to understand. And that is why this year we are targeting to create an impact on each and every stakeholder, each and every member and student of our profession. As in true sense, we have a family of almost 13 lakh CA students and members, then definitely we have to understand our role in a different way. And with this impact, where innovation, change of mindset, professional excellence, adaptability, collaboration, and transformation are the core pillar which we want to drive during this year. And we have come out a very unique initiative, that is CA Nexus, which is related to the partnership and collaboration amongst each other. Then Market on Monday, again a wonderful initiative. Every Monday we are discussing for the capital market and financial market. And then Sustainable Sunday, giving back to society is really important for all of us. And that is why we are discussing ESG, carbon credit, and such type of program on Sustainable Sunday. We are doing some physical activity also in terms of cleaning of sea, tree plantation, blood donation. These all are the initiatives. Then WRC Corporate Setu, again a wonderful initiative through which we are gaining footprint from members in industry, which is at most important for all of us. And all other initiatives are also available on WRC website. Please have a look on that. Friends, there are some programs which is very, very important to understand, and it is much needed for the participation. So we have come out with so many programs, but I want to highlight some of them. That FinTrust 2026, we are doing cybersecurity, digital trust, and DPDP conclave on 22nd August evening at Leela Hotel, and we are expecting CIO, CISO, and chartered accountant participation over there. Then we are hosting FCRA amendments and taxations and Indes, and most importantly, the boardroom excellence program, which is at the most important to understand all the action points which is required in the boardroom from the chartered accountant, from the independent directors, treasury auditors, all are going to be discussed in this wonderful boardroom excellence program. And then, as we all know, that financial market is very, very important for all of us, and that is why we are hosting national conference on capital market on 21st and 22nd August, and that is going to be hosted at the Leela Hotel Andheri. And looking forward for your participation, as all the stalwarts of the capital market are joining in the national conference. And then an important buzzword, AI. So again, we are hosting national conference on AI on 14 and 15 August at Terapan Bhavan, where we are expecting more than 500 chartered accountant participation, and all the need-based topic is going to be discussed in this wonderful national conference on AI. Looking forward for your participation in the same also. Then under the leadership of our PD committee chairperson, C.A. Sweta Jain, we are we have come out well in advance for our signature program, that is the regional conference, which we have to understand in a different way. We are going to discuss about Divya Drishti, Vidya, vision, and values in this conference. We are expecting more than 3,000 chartered accountants, and I can say the unique experience in terms of connection, collaboration, and networking can be achieved by participation in this conference, where more than 100 speakers and exhibitions are invited. And looking forward for your participation in this wonderful conference also. Then, very, very importantly, after a long period, we have received approval for INTCON in Mumbai, that is the international conference for CA student, and where we have to motivate our articles to participate in an international conference of CA student 2026 Vishwa Setu, which is happening after a long time in Mumbai, and first time in the history of ICI, I can say, that a space like Geo Convention Center is targeted for the students, and it is require a lot of efforts and courage. So we have to motivate our students, and I can say that more than 20 countries students are going to be the participant in this wonderful Vishwa Setu, where we are trying to connect trust and create an impact on our fraternity. So looking forward for effective contributions. Once again, compliment to each one of you for your joining in this wonderful webinar, where we are going to discuss all about the arm's length architecture. Over to you, Vishen Bhai.
Thank you very much, Chairman sir. And we feel so pride that you are there to elevate all of us. And as rightly said, so far as the our regional conference is concerned, and chairperson of the regional conference is also here, our senior regional council member, C. Shweta Jain madam. So it is a time of traveling from I to we, as you have said, Vidya, vision, and value. So we is very much important, and that is what we all are feeling currently, that we are one at WRC of ICI. With these, now I request our Vice Chairman, CA Rikin Patelji from Baroda, to give introduction of our learned faculty. Over to you, Rikin Bhai.
Thank you so much, Vishan Bhai, our Power Pack Secretary of WRC, and kudos to our chairperson for such a wonderful program. I also acknowledge the presence of CA Shweta Jain ma'am, who is also always there for all the initiatives of WRC. And today we have with us CA Ajit Jain sir, who is a partner and head of transfer pricing at AGMS Global with over 14 years of experience in transfer pricing and international taxation. He specializes in TP advisory, dispute resolution, value chain analysis, and cross-border restructuring for multinational enterprises. An ICAI International Research Awardee in the year 2020 as well as in 2025. He is also the exclusive educator for Kalpan Mena's UAE TP diploma course and a frequent speaker at leading international tax forum. He is a chartered accountant and holds a diploma in tax technology from the UK and is a published author on arm's length analysis. With that words, we welcome you, sir, for today's session. Back to you, Vishan Bhai.
So before requesting to the speaker, Vishen Bhai, I like to request C.A. Shweta Jain madam to have their words, if anything she want to say.
Thank you, Chairman. Uh, just only this is really a good initiative, and from this session, members, I'm very sure that they will be benefited. So it's time to hear from directly from the speaker. So I will not come in between. Only the thing is, since you all have mentioned about the regional conference, it's our signature event. My request to all the participants, please register as soon as possible, because early bird discount is, I think, already is gone, and next after 1 month again the rate will be increased, the charges will be increased. So this will be a definitely a landmark and a experience for every member to attend this conference, where 100 speakers are going to speak about our profession, future of our profession. It's definitely not missing type of event. So requesting everybody to please register well in advance. Thank you, and over to you, Ajit ji. Thank you.
Yeah, thank you, Shweta ji. And thank you, WRC, for giving me this opportunity. I would like to thank you, Chairman Sir, Vice Chairman Sir, Vishan ji, and special thanks to Shweta ji for accepting this important topic for presentation in WRC. And over and above, I would like to congratulate WRC and under leadership of Saurabh ji for initiating, taking so many initiatives in your leadership across various fronts, not only in the key domain area but outside the domain for the overall development of the overall profession. So it's a significant initiative, and I would like to congratulate and wish you all the best for the for their future programs. So with this, I would like to share my screen and. So as I said, today's topic is arm's length architecture. Now, the important part of today's presentation is that we are not going to discuss any regulations or any provisions or any compliance. The objective of today's session is to talk more about systems, more about the designs of the data, what we need for transfer pricing analysis. And this is one of the most underrated topics. And why I'm saying this most underrated, if we see last 1 decade, or maybe last couple of years, there have been significant change in the value chain of the business globally. The companies and the organizations are transforming through technologies. The organizations are not linear, they are more integrated. use of artificial intelligence. Now, we keep saying that the regulation should evolve, but at the same time, we also need to think that we need to advance our thinking in terms of understanding the value chain and the business. Because end of the day, when we look at the transfer pricing risk, when look at the court rulings, a lot of court rulings are decided based on the substance, based on the understanding of the value chain, based on how the data is managed, right? And one important thing, I work across number of countries, and one important thing I've observed that not everything can be written in the local transfer pricing regulation, and that's the important part of transfer pricing. If you look at the Indian TP regulations, there are a number of sections, there are rules, provisions. If you look at UE regulations, there are only 4 paragraphs in the law. The guide is almost 400 pages. The point I'm saying is that there are so many things which is not written in the regulation, which will never be written because those are practical aspect in terms of the managing the data, managing the entire architecture. But before we go into the architecture, we need to understand that where the global transfer pricing moving, the OECD, which is the key the premier organizations for developing the entire international standard, has been putting a lot of efforts in bringing international guidance, bringing the base erosion actions which we all seen in 1 decade back. But then the implementation needs a lot of understanding from the business side. So today what we are going to cover is, the first is the value chain, that how businesses evolve over the period of years. And when we do the transfer pricing analysis, we cannot miss the value chain and the entire supply chain of the business. Then we'll discuss the arm's length architecture. Now, what I mean when I talk about arm's length architecture means not just what is defined in the regulation, but we need to go into the OECD's, the model convention definition of the arm's length. While we all can say that the OECD is not binding on the when we talk about the Indian regulation, it is not binding clearly, but at the same time, we all can see that wherever there are landmark rulings, they all refer to the OECD guideline. They all refer to the substance. They all refer to the control. And in fact, even taxpayers, we as a consultant, when we analyze, we always give reference to the OECD's para. So while it is not binding, but we need to understand that one thing, that in transfer pricing, any problem can be solved by sticking to the fundamentals of the transfer pricing. And those fundamentals, there's no place better than the OECD guideline. There's no better definition than what is defined in the Article 9. And that's what we are going to discuss today, that how what is the definition? What is the overall formula of the arm's length? And one thing which, last couple of years, I have strongly followed that I've never used the term benchmarking analysis. And that's where I'm going to discuss today that why it is not appropriate to use the benchmarking, because a lot of places it is replaced. The arm's length analysis is replaced with the benchmarking analysis that we're going to discuss. Then we'll discuss the TP policy design, that how we can design the TP policy proactively to mitigate the risk. So the point I'm saying is that we always think that TP is, in many cases, TP is a compliance, wait for the audit, let's audit happens. If something goes wrong, let's do the changes in the local file. But then what about design of the system? What about the policy internally? And in fact, as a consultant, I'm saying that if the data is managed appropriately internally, more than 50% of the transfer pricing risk can be avoided. And that's very significant. In many cases, the data management is not even updated, even after we have so much of learning, almost more than 1,000 or more than 1,500 transfer pricing rulings now in India. We can do reverse engineering and get the great learnings out of it. So we'll discuss the TP policy design, then we'll discuss the operational transfer pricing, that how the data should be managed in the ERP. Then we'll talk about another interesting concept of value chain analysis. Now, that's not very much focused specifically in the South, in Asia Pacific region, but if you talk about US and UK, where the intangibles are leading the transfer pricing, value chain analysis also plays a very important role. So with this, I'll start with the first thought process around our analysis in transfer pricing. So over the period of years, we have seen that there are a lot of compliances in transfer pricing. We at the end of the year we file Form 3CB. Now it will be replaced with the Form 48. But then our focus has been always talk about regulation, that what regulation says, the interpretation of the regulation. Our focus has been the compliance, that how to determine the arm's length or price by doing benchmarking. Our focus has been, okay, let's see what happens is audit, what the transfer pricing officer has done, what the ruling is. But then there are two important aspects we are missing. The first is the business and value chain, and the second is implementation in the system. Why I'm talking about business and value chain? Because as I said, the today's value chain are not linear. They are more integrated. Use of technologies. You will never see any company where there's a separate department for the related party transactions or associated enterprises. The departments are, they're jointly working. They're sharing of joint resources. Technology is being shared. Use of artificial intelligence. So many things. So can we, in today's such an integrated world, can we really rely upon a functional analysis? Can we rely on the functional analysis which is performed based on the interviews and based on the confirmation? Or do we really need to go deep into the value chain and understand from each of the stakeholders? Right? I give you a recent my experience. I met a couple of days back with one of my friend who is working in industry, and he's saying that in his company there's a department where there are a lot of decisions taken by AI agents. The AI agents is set up in one place, and they are all working in different jurisdictions, different countries, and they are taking decisions. Now, can we imagine that today's transfer pricing, is it enough to address those challenges of the artificial intelligence? Is it enough to address the challenges of such a collaborative effort where we don't know who is controlling the information, who is controlling the decisions? So it is very, very important to understand the business and value chain. That's one. The second is the implementation. A lot of cases where we have seen that as a consultant, I have recommended the TP policy. Let's say, let's go ahead with the cost plus 10% for your services. But then it's always challenging for the person who is working on industry side, that how should I implement cost in the ERP? Have I taken the cost correctly? Because the cost which we take for the transfer pricing is different. We take the operating cost. We should not take any non-extraordinary cost. Is the markup is appropriately captured? Is it true up and true down done at the year end? It's very, very important. And from there also we can reduce the transfer pricing risk. So the point is that today we are going to look at the transfer pricing from a different scene, different perspective, because it is not a subject of compliance. It's a subject of boardroom governance. It's a subject of corporate governance, significant risk involved. And when we look at transfer pricing from a system and design perspective, that there are a number of rulings I can tell you that which gives us significant learnings to us, where we can redesign the system. And we, even as a consultant, I'm saying that a taxpayer can reduce their consulting fee cost, if the designs and systems are built. So business, regulation, implementation, compliance, and then audit. These are the 5 pillars on which the transfer pricing analysis should be made. And we should not only stick to the regulation, compliance, and audit. The business and implementations are the most important part, considering how the world is moving to the technology, how world is more integrated. So as I said, now the businesses are not a straight line, like make, warehouse, distribution, retailer. They are working more integrated way. There are sharing of resources, sharing of technology. In India, we have seen a lot of GCCs is coming up. And normally, when we talk about GCC, it is being said that they are the back office center, capability centers. But then the number of cases where they are developing the IPs, intangibles, they are back office, but they are developing intangible. Do we have a framework where we can see those kind of models in a more in an integrated way and find out the solution from a transfer pricing perspective to avoid any risk? Because just because we can say this is GCC, we cannot conclude that the GCC should be remunerated on a cost plus basis, right? We need to understand the model. We need to understand how the resources are shared. We need to understand where the value is created. So the focus should be on the conduct, where the value is created. Now, value can be both side these days. These days, the value can be both side. Even an entity is providing support, can also at the same time developing something. We can take example of the pharmaceutical industries where a lot of R&D is done in India, but then at the same time, some new molecules can be developed. Now, have we evaluated that separately? That is, can there be intangibles separately developed? So the point I'm making here is that we need to see transfer pricing now from uh, two perspective. One is the value creation perspective, not just a straight line that this entity is a manufacturer, this is a distributor, should get routine return. There can be a cross sharing of resources. There can be different contribution in the entire value chain. So this is the whole perspective that our business, the global businesses are changing, while the regulation may or may not change. But the point I'm making here is that it's our, if I'm a transfer pricing consultant, or if I'm a person working on industry side, we need to understand that how we can address these challenges even within the current framework of the regulation, how we can do that by managing the strong, robust databases. So the new reality is that the value chain is now is a network. Now it's not a straight line distributor. We cannot directly just say that, okay, you are a distributor, you should earn routine margin. We need to understand, right, what the distributor is doing. A number of cases I've seen that there is a contract of distributor, and the contract says that the distributor is expected to earn assured return 2% or 3%. And that's what also documented based on the discussion, based on the functional confirmation. But I have observed in a couple of cases when I talk to number of more stakeholders, I get to know that there's more activities being performed. Distributor is engaged into negotiation, decision making. There are a lot of other efforts being made. Now, contract is important, but the conduct is the most important in transfer pricing. Conduct override contracts in transfer pricing. So we need to understand that what the actual conduct is, and not all the time the conduct is documented. And that's the important part when, as a taxpayer, we need to learn. I mean, a taxpayer needs to learn that we need to document the conduct appropriately. Value, today's value lives in software, data, and AI. The world is changing. A lot of hardwares are changing into software. Are we ready to address those challenges from a transfer pricing perspective? Because in many cases, we even don't find comparables for those situations, specifically in the artificial intelligence related thing. Even as I take an example of GCCs, in addition to the routine work, there are R&D is being done. Some new, incidental invention is done. All those things, if they are intangible, the entity should be compensated. If it is not, there can be risk from a TP perspective locally. So I take an example of the landmark ruling in 2025, last year only, for IT-80 Mumbai. And it's very important example when we talk about the value chain. There were the IT-80 rule in favor of the taxpayer, where Netflix US is basically owns content, legal owner, and also the economic owner for the entire content. And it is basically providing license to the Netherlands entity, content and marketing license. Now, the role of the Indian entity was just to distribution of the access only. If we see Netflix in India, the Netflix India is distributing the access, the management of the overall Indian operations, the distribution part only. Now, Netflix India has access to certain devices. It is also managing. And then the transfer pricing officer said that Netflix India is an entrepreneur, and there should be an adjustment, and 445 crores of adjustment made by putting royalty as a notional adjustment. And that was done without even understanding clearly the business model, that what the entity is doing, what the role is. Now, just the point is that just because the characterization that entity is managing the technology, entity is managing the content, we cannot say that the Indian entity is an entrepreneur. To define, to characterize the entity as an entrepreneur, it is very, very important to understand that the entity is what the functions of the entity. The entity is just providing access to the content only. It is not taking any risk. It is not taking any control of the data. Everything is decided at a US level or at the Netherlands level. And if the entity is doing, even if it has access to certain devices, it will not make the entity as an entrepreneur. So the tribunal said that DEMPE, which is the important concept in determining the returns for the intangibles, which is development, enhancement, maintenance, protection of the intangibles, wholly sits offshore. It is not with the Indian entity. While the Indian entity managing some devices, but doesn't mean that it is controlling. So the tribunal said that after looking into the entire value chain, entire business model, the entity locally is a limited risk distributor. It is not taking any decisions. It is not taking the control of the functions. Now, tribunal has used the word control. I'll talk more about the control, but that's what the outcome is. Now, why I've discussed this ruling is basically to understand that at the end of the day, we need to understand the value chain and the business model, how it is designed, and the taxpayer has designed its business model in such a way that everything, all the control, not only in the contract, but in the conduct also. And there are evidences of the conduct which is produced before the tribunal that there's no decisions. All the decisions are taken at a headquarter level. And because of the same, the tribunal said that you're low risk making entity and entire adjustment is disregarded. So the point is, there are many such models, even more complex model, including artificial intelligence, more integrated model. We need to understand the business, we need to understand the product, we need to understand the economic circumstances, then we would be able to take the right decisions. Now, how we can do that? Once we have the clear understanding of the arm's length principle, we should not directly jump to the benchmarking analysis. Now, there are certain other example also in Indian context. There are several rulings where Netflix, we already discussed. There are Gap India sourcing, where the officer had taken entire cost and applied a markup for the sourcing activity, but then the entity is just a sourcing entity and not basically the value addition is only the sourcing, only the entity is not taking any risk. It is just sourcing and helping the associated enterprises. Only the cost percentage is added on the value creation. So the point I'm saying here is that the idea is to not to discuss ruling. The idea is to think about the reverse engineering, that in such a situation, can we reverse engineering and design our model from the day one, that wherever there is a transaction, such kind of transactions where we need to add a markup or we need to add a percentage on sales, do we have a design in the place? Do we have a system in place so that there's no conflict, not at the audit level, but even at the compliance level? From the day one, we should decide that what should be the base, the cost base. Now, that decision should be documented in the agreement, should be part of the ERP, should be part of the invoicing clearly. A lot of cases, the invoicing is raised, but then even invoice does not discuss what the transaction is. When the invoice does not discuss it, it creates a conflict. So the operational part of the transfer pricing is not just discussing the ruling, but applying the reverse engineering. Can we design a model where we don't need to spend a lot of time at the time of compliance? We don't need to incur a lot of cost for the consulting. We can design system internally in such a way which reduces the complete risk to the extent possible. Another example would be the Galileo, where the officer said that every travel booking is done in India, but then when at the upper level it is evaluated, the overall supply chain, the local entity is just booking, not taking any decisions. So another example of thinking about the design of system, that how we can design or maintain document in such a way which reduces our risk. It can be invoicing, it can be ERP, maintaining agreement, it can be maintaining the email correspondence, talking to different stakeholders. I'll talk about function analysis in the subsequent slide. Then there's a case of marketing intangibles. So marketing intangibles is one of the most litigated topics in India, and the primary contention is always that it's not international transactions, and that has been the primary contention. But then on a without prejudice basis, a lot of discussion happened on the AMP spend and the characterization of the entity. Now there can be a design rules can be framed at the very beginning of the year that if my marketing spend is significant during the year, right, I should maintain a ledger that, see, I have incurred marketing spend for the product which is only sold in India. It is not incurred for the product, even if it is part of the group, which is owned legally and outside India. I'm the economic owner. That logs can be maintained, that products can be maintained, that a report can be maintained at the beginning of the year, that routine and non-routine expense can be maintained. This is the non-routine, but who is getting benefited from the non-routine, right? So I give you an example. One of the case where I was even representing before the transfer pricing authorities in India, and officer said that you have spent so much on the marketing expense. Then, in fact, we have shown the product which is sold in US, the real product to the transfer pricing officer to see, sir, see, this is the product which is sold in India. This is US. These are the different products. And whatever we have incurred in India has nothing to do with, we have nothing to do with whatever we marketing spend, nothing to do with the product which is sold in India. So in a way, I'm not contributing to the brand. So the point I'm making here is that not basically talking about the resolution of the cases, but thinking about the mindset we design the system, that how we can design the system in such a way that we face the least amount of challenges. If I'm paying royalty from the last 10 years, why I'm paying royalty? I should design a system. System tells that this is the reasons why I'm paying royalty. So this is just an example that we should look transfer pricing from a business perspective now, look transfer pricing from a system and design perspective rather than compliance and audit perspective. Because if we don't apply reverse engineering, we will never be able to apply or design systems which basically reduces the overall risk. Now we come to the arm's length principle. Now here I'll be discussing the core Article 9 of the OECD Model Convention, the main definition, and OECD being the Bible of the transfer pricing world. It is important, as I discussed earlier, to discuss this definition. Now, I'll not go into too much of interpretation. The point I'm saying is that a lot of cases, the arm's length analysis is replaced with the benchmarking analysis in a lot of conversations that I want to do benchmarking for these transactions. But then we are losing the bigger picture. And it's not only about the interpretation, it's also about the mitigating the risk. Today we can discuss that, okay, let's do the benchmarking, let's conclude the transaction on an arm's length basis. But then when we look at the litigation, what has happened, it talks about control, decision making, commercial rationality test. A lot of tribunals rulings disallowing the royalties. Now, those are not even discussed at the benchmarking level. So it is very, very important to understand the crux behind the arm's length principle, and its benchmarking is just one part of it. Benchmarking is not cannot be replaced with benchmarking should not be replaced with the entire arm's length analysis. Now look at the definition. They start with the where conditions are made or imposed between two associated enterprises. It starts with the conditions, and which is very, very important. When we talk about conditions, our mindset changes that today, if I have a transactions and I'm comparing with some third party transaction, our conditions are matching. Even if it is internal prices or internal cup, conditions, our condition match between the taxpayer and the associated enterprises are matching. Now, it is not possible always, all the cases where we do the external benchmarking, we get to know about the conditions of those companies. We get to know the financial, their trade descriptions, their website description, and based on the financials and our best judgment, we take the decisions. But the point I'm making here is that the point condition is very important to understand that if I am benchmarking a limited risk distributor, I cannot take a distributor who is an entrepreneur. So conditions is very important. right? If I cannot take a distributor as a, if I'm doing a benchmarking or analysis for a contract manufacturer, I cannot take a comparable which is a manufacturer but also doing some level of R&D. We need to understand the conditions, focus on the conditions, and then our mindset would changes from the finding the numbers to finding the real conditions. And that is very, very important when we talk about the application of the arm's length principle. Now I'll directly come to the formula. Now, so far our formula has been that let's do the function analysis, let's do the characterization, manufacturer, distributor, contract manufacturer. Um, what we usually do, we look at the financial, we do the functional analysis, we take the interviews. The financial says that okay, the entity is a distributor, purchasing goods and earning decent margin. Let's do the benchmarking and we are done. But then, if we really see the Article 9 of the definition, the formula is more deep. The formula talks about delineation of the transactions. The formula then talking about testing from option realistically available, commercial rationality, and non-recognition perspective. Then comes to the pricing. Now, delineation of the transaction is very, very important. Now, it includes the function analysis. It includes the 6-step framework of the control and risk, and it includes the conduct as well. What is the actual conduct? Now, I give you my personal experience. In many cases, we do the functional interviews, and normally we meet the tax head and finance head of the company, and we interviews that what company does, and we document and we take confirmation. That's how it works. But then I've seen number of cases where tax authorities would try to meet other stakeholders. In one of the cases, tax authorities said that I want to meet the research head of the company or operation head of the company tomorrow. And that person had no idea about the transfer pricing. So the point I'm making here is that whenever we talk about the functional analysis, it is not just about doing the functional interviews and taking the confirmation. And interestingly, I read one very interesting research paper a couple of months back. It was on transfer pricing only. It was talking about confirmation biased. We all humans are, whether we agree or not, and honestly speaking, we are biased towards confirmation. If today I get to know that somebody is confirming, yes, the function analysis today is same as last year, we agree, we got confirmation. But this is not how it works. We need to go into the deeper, we need to talk to the different stakeholders. Because a lot of time, if we really see, the most practical challenge is that there are the departments in many cases are not well coordinated. They may be coordinated from technology, but they're not coordinated in terms of information in each and every area. And that's the reason there can be lack of information, and then we rely on the confirmation bias. So the point I'm making here is that when we talk about the delineation, what's the real deal? It's include the function analysis, it includes the control and risk analysis, it includes the actual conduct of the entity rather than what is written in the conduct. Now, if you want to do that, we need to talk to different stakeholders. We need to talk to the operation head of the company, research head. I'm not saying all the cases, but wherever we feel that the supply chain is more dense, more deeper, it is very, very important to have the full visibility of the entire value chain. And that's when we would be able to say that, yes, I have delineated the transactions completely, not just getting the confirmation, but I collected the evidences as well. In one of the recent cases, the invoice in one of the transactions, the invoice is saying that, yes, there's a services being rendered and services are charged at a cost plus 10%. And then, this was invoicing. Now, in normal circumstances, these services are kind of a research services, right? If we just rely on the invoicing or maybe some confirmation, we could have directly started benchmarking or maybe evaluating based on function analysis. But then I went into the deeper and then found out that there's no research. Some people have the entities actually supporting the facilitation of the some employee on a secondment to other entity, just facilitation, nothing else. And entire 10% charge is made on the cost of those employee. There is no research services being rendered between one entity to another entity. Now, then the delineation is not incorrect. The real delineation comes when we really understand the transaction, not just concluding based on what is written in the invoice. So that is delineation. That is the first stage of the definition of the arm's length. The second is the testing. Now, testing is we need to understand the three aspects. The option realistically available, we'll discuss in the subsequent slide. The commercial rationality, is the transaction is really commercially rational, and non-recognition. Now, these aspects are really, really underrated when it comes to the local TP regulations. And I'll talk about it. The OECD is discussing in deep, and specifically the option realistically available is highly underrated. I'll give you example also in the subsequent slide. So testing from this, and finally your pricing will come with the comparability, with the adjustment, and selecting the method. Now, if we look at this definition in a deeper way, we will find out that the arm's length principle is not just about benchmarking. It's about the understanding the conditions. It's about understanding the conduct of the party. It's understanding the best alternative option available. And that's how it is designed, right? One important aspect line I always focus is that transfer pricing is the arm's length principle was never discovered. It was designed. It was designed by someone. It was designed by a team of people. And taxpayer also has an opportunity to design the system accordance with this to mitigate the risk. So I was talking about the commercial rationality framework. Would rational business would have done this? The two things basically uh, uh, comes under this, that we always think that, okay, I've determined the transactions from an arm's length perspective. I have done the function analysis. I give example. There's an entity which owns property in a highly flood area, and it basically other entities insuring the other entity, related party transaction. The function analysis is done. It is an insurance services. But on a commercial rationale, the entire transaction would fail, because in a third party situation, nobody would pay for like nobody would accept insurance for such a property which is complete in the flood area. It will be completely failed, right? So the point is that the commercial rationality, which is not totally discussed, that it is not necessary that we need to have a third party transaction available in our analysis. It is, but the point is that if we are entering into transactions and making some payment, if there would have been a third party in imaginary situation, whether that third party would be paying for such services? No, because it is commercially irrational. Nobody would pay for it, right? So that is the whole point, that nobody would pay for it. Now, taking another example, I'm paying royalty to one entity from last 20 years for similar thing. Some technology which I'm adopting, routine technology, or same thing I'm paying technology royalty for 20 years, right? If we see that royalty from a commercial rational perspective, that after 20 years, where technologies advance in each country, is it commercially makes sense to pay the royalty for the same technology which was adopted 15, 20 years back? Nobody would pay, right? The company will either adopt locally or build some technology in-house. That is called commercial rationality angle of the arm's length principle, which is generally is underrated. So we should keep in mind when we look at this kind of transaction, it is not always about finding the third party and say, okay, I'm at arm's length because I've done the benchmarking. It is also looking into the transaction from a commercial rational perspective. Now coming to the one very interesting concept, which is not discussed in the local TP regulation, and I would say highly underrated. And I would say if applied in a local regulation, if applied in number of rulings, it can be a game changer. The option realistically concept says that a party enter into a transactions only if it is not expected to leave them worse off the next best alternative. So the point is that today, if I want to purchase a raw material today on the beginning of the year, I want to purchase a raw material and I'm trying to purchase from my related party. What I would do based on this concept, I'll not look into the related party procurement, I'll see that can I get that material locally from third party? That is the best alternative option available to me, because first I'll avoid all the shipping logistic cost, plus I'll get in a better pricing. And if I purchase from related party, that would create other issues that would put me into transfer pricing. So the point is that this concept is saying that, do I have the whatever transaction I'm entering into, is it the best alternative options available to the company? If it is not, then there might be a challenge from an arm's length perspective. So I give you an example. Even I practically applied this. So I give you an example of Middle East, where there's one entity which is owning the so there's one entity which is basically owning the entire mall with number of shops. Now, what has happened is that mall is in an area where in an area where because of some other issues, the customers have completely shifted, and that become a dead area for that mall. Now that entity wants to give that mall on the rent, or to the customers, to the business owners. Now what has happened is the other entity or the same group helped the mall in basically putting all the managing entire mall, not only managing, but also ensuring that all the shops of the mall is being rented to the respective businesses. Now the other entity has great relationship. Other entity has a great basically network of people, and because of this entire network, that mall has basically put on rent, and even in a dead area, that mall is working. Now what options available to the original owner of the mall? Either kept the mall idle capacity, earning nothing, or to give to the related party who has a great relationship. Now the other entity was just managing the mall and using network, but it is claiming that because I have relationship and network, I should be claiming 50% of the rent, even I'm not the owner. Now that is called options realistically available. There is no options available to the owner of the mall better than to give to the in the authority of the related party. That's the best options realistically available in the given circumstances, to use the network of the related party, to use the efficiencies, to do the entire infrastructure of the related party. And that's the option realistically available, either to keep it idle or to give it to the related party. So that's an example of the option realistic level. We can find many other examples. So this is another angle of the arm's length principle, which is highly underrated. So the point I'm making here is that when we talk about arm's length principle is not discovered, it is designed. Whoever designed a couple of decades back, it is designed, it is not discovered from someone. So similarly, when we apply the arm's length principle, the application of the arm's length principle, it is not about finding a number. We are not discovering one number, though, okay, this is arm's length. It is basically finding a well-designed price that makes sense. That price may or may not align with the third party. But today, if I feel that, yes, it makes sense based on my analysis, my circumstances, it will make sense. I need to negotiate it. But the objective is never to discover some price, but design something system in such a way that it makes sense. So arm's length price is not designed, it's discovered. And when we talk about discovery is about doing benchmarking, concluding functional analysis based on interview, and just backward looking that what is the last year's margin and concluding accordingly. And then design is talking about this designing at the start of the year, looking at the option realistically available. Is this transaction commercially makes sense? Is it a forward-looking forward-looking approach? Is policies maintained? Then we will think that, yes, we have a designed arm's length rather than discovered price. So Another some of the interesting aspect of the arm's length principle, which is highly underrated. One thing we need to understand that the arm's length principle is an approximation. It is not one price. A lot of cases we think that yes, we did not find good range, we did not find pricing for this in the market. We need to understand, OECD keeps saying that it is not an exact science, it is an approximation. We need to reach out to the best possible based on availability of the data. The second important aspect of the arm's length principle is it is an allocation and not anti-avoidance. A lot of time when we think about transfer pricing, we start thinking about, from the perspective of the tax avoidance, that okay, is it transaction is avoiding tax? There's a risk. This is the pricing, and it looks like this is an avoidance based erosion. But then we need to look into the real deep into the arm's length principle. It is not in the first place anti-avoidance principle. It is an allocation principle. We need to think from that mindset. Are we allocating the returns of the arm's length principle based on the allocation mechanism defined under the principle, or we just directly looking into from a base erosion perspective, right? So this is very, very important from a taxpayer's perspective, that it is an allocation. Today I am doing some allocation, which I feel that yes, it is reasonable. Even if I don't find any third party comparable, I have the logical reasoning for that allocation. I will do that because I have enough evidences to do that. And that is one of the underrated concept in transfer pricing. The range is the answer and not the median. Now, while India follows the interquartile range, I'll not discuss into that, but the OECD says that it is an approximation, it is a range. We should not stick to the one pricing that, okay, let's go, the median is appropriate. It's a range. And any point in the range can be an arm's length. There may be implications, right? There may be other implications. Now, Pillar 2 is coming, not in India, but other globally, there may be implications because of the lower quartile, upper quartile, because of the median. But it is not one price. It is an approximation we need to understand. Another aspect is, just because there are no comparable, it does not mean that the transaction is not arm's length. A lot more cases, I come across that there are no comparable exist. This is very challenging. Let's do TNMM approach at entity level, because for a transaction no comparable exists. See, just because there are no comparable exist does not mean the transaction is a non-arm's length. There can be various ways and means to determine the arm's length situation, determine the market price of the transactions. We need to understand from a substance perspective that what the substance. And I give you example, not from an Indian perspective, but one of the example from a UAE standpoint. We all know that in UAE there's no income tax, and then there is a provision that the salary paid to the owner needs to be at arm's length, because if it is not arm's length, the companies can take advantage of double non-taxation. They will take deduction benefit, and at the same time individual take the benefit of tax. Now, there's no guideline which is there that it should be what should be the salary. Every company can pay different salaries. The point I'm making here is that just because I don't have the comparable rate or comparable salary, I'll not say that transaction is not arm's length. What I will do, I will look at the transaction from a commercial standpoint. That is this person is really putting efforts? Is this the company is generating real profit? So the point I'm making here is that it's not only about the comparable, it's also about the economic and commercial situation and the substance through which we can determine the arm's length pricing. Now coming to the interesting part of the today's session is the transfer pricing policy. But before that, the interesting part is that the OECD uses the term control 200 times. Now here, when I'm talking about control, I'm not referring to the definition of the associated enterprises control management capital. I'm talking about the control over the risk, control over the decision making. OECD is using, and you will find in any country's local TP regulation, the local TP regulation is not talking about the control. Now, this is very, very interesting part, because when we look at the lot of global, not only Indian rulings, the global rulings are decided based on the control, the decision, the control over decision, control over risk. Normally, when we prepare the local file, the TP study, we focus on the functions, assets, and risk. We focus on summarizing the FAR. But when we look at the OECD, the OECD's BAPS action plan 8, 9, and 10, which is now part of the OECD's transfer pricing guideline, it's clearly talking about that the returns to the entity is dependent on how much control exists on the functions, how much control on the risk. On that basis, the control is defined. In fact, if someone look at the OECD, one should look at that there should be a control matrix instead of a FAR summary. Decision matrix. A lot of time when we look at the rulings, a FAR functional analysis being described and managed, documented. But in the entire function analysis, hardly we'll find the word control is used. Control of risk, control of financial capacity to assume the risk. Now that is very, very important. Now why this is important? Not just because OECD is saying this, and a lot of time we say that it's not practical, but because to avoid risk from a transfer pricing perspective, understanding the control is very important, because as I said, the departments, the organizations works integrated manner, and understanding the who controls what is going to be difficult, because the resources are shared, the data is shared, the use of artificial intelligence. If we don't understand, identify which entity really controls the data, the algorithm, the controlling the function, the controlling the risk, it's going to be difficult to understand the real characterization. Now, before I come to the TP policy design section, this is the slide which almost I uses in all my presentation, is that normally we see transfer pricing from a compliance perspective and audit perspective, but the real transfer pricing start at the time of decision making. Do I need to enter into this transaction or not? This is the decisions option. Really, this is the best option. Then start with the planning, that what is the pricing mechanism I should apply? How I am going to implement in the ERP throughout the year? What would be my invoicing mechanism? If we follow that mechanism from the day one, I can tell you we can reduce significant risk at the time of audit. Not only at the significant, we can reduce the significant work at the time of compliance. Not only work, we can significantly avoid the risk at the time of audit, because we have a significant level of data is being maintained. So transfer pricing does not start at the compliance, start at the time of decision making. So we already discussed this. Transfer pricing should not be kind of a discovery exercise. It should be a designed exercise, design of the agreement, design of the evidence for the conduct, design of the system, ERP system, design of the overall evidences showing the conduct, right? So it can be function analysis, it can be policy analysis, design of the interrelated coordination between the department. A lot of time risk comes because the finance and the operation departments are not interlinked when it comes, connected when it comes to TP policy. So this is very important. Now we'll come to, with this background, now I'll discuss the TP policy first. That we know what is the arm's length principle is. It is not benchmarking. It is also looking into evidences, understanding the control, decision making, control of risk. Then we should have a transfer pricing policy in place. Now, transfer pricing policy is not a mandatory document, but I've seen global companies are maintaining the TP policy, which is very, very important. Otherwise, it would create chaos between the companies and the organizations to manage the transfer pricing at a global level. So TP policy is not a TP documentation. It's not a benchmarking study. It's a governing document prepared at the beginning of the year to set the entire governance of the transaction, including the benchmarking, including the arm's length analysis, including the function analysis, including the control matrix, and also including how the different departments would implement this policy together. So today I have a policy of cost plus 10. It's not just include the benchmarking, it includes the governing framework, that how this operation department would look this into TP policy, how it is framed into the transfer pricing designs, ERP. So this is the TP policy, including the entire governance, not only the benchmarking. Now, the core component of the transfer pricing policy is the first is the characterization matrix. This is very, very important that we need to lock the characterization at the beginning of the year rather than waiting for the year to end. A lot of cases I've seen that we don't know whether it is a distributor or limited risk distributor. We'll see at the year end when we do the benchmarking, we do the analysis, but then that creates a risk not only for the audit but also overall financial strategy risk, cash flow risk, because at the year end there could be a significant true up, true down adjustment. So characterization lock is very important. TP method, risk allocation matrix, which entity is taking the risk. Now, one of the important concept is issue which I've seen a number of cases that when we talk about risk, we talk about one side analysis. Okay, the local entity is the overseas entity is taking the risk. It means automatically the local entity is low risk entity. This is possible. The overseas entity taking the risk, it means the local entity is not taking is a low risk entity. Now, this should not be automatic. It should be dual analysis, and that should be evaluated as a part of TP analysis. Dampe ownership table for the intangibles is very important again. And one of the interesting point which I would like to talk here is that, which is very underrated, and we have all seen the payment of royalty transactions. Can be routine transaction in many cases. Entity in India is paying royalty for technology. In most cases, we use the term benefit test for the royalty, that what benefit the companies has availed. But if we really see the OECD's guidance, the term benefit is used primarily for the intergroup services, not for the royalty. Royalty is attached to the intangible which is legally owned by the other entity. And when the intangible is legally owned, it is the Dampe analysis which needs to be performed. Even in case of royalty, that see, we have performed the Dampe analysis and I'm just exploiting the intangibles, and for which I'm paying the license fee. Entire Dampe sits with the other entity. And that way, it not only include the benefit test, but showing the actual allocation of the return in form of the license fees. So this is one of the important part, should be part of the transfer pricing policy. Another interesting part is generally agreement says that the distributor is entitled to a assured return, and that's it. But it is very, very also important that the contract should also say that the distributor is not entitled to perform these many activities. The distributor is distribution is not authorized to perform marketing activities, negotiation, the forbidden activities. Why? Because sometimes it helps before the tax authority to show that yes, see, we are not performing any activity, and this has been agreed and signed between two entities. And one cannot notionally identify some other activity just because something is done. Even if it is performed with the guidance of the parent entity. So forbidden list of entities also helps a lot of time. Pricing formula and ranges also very important when we talk about the TP policy, that how the pricing is decided. TP pricing and TP method is different. If the pricing is cost plus, the method can be TNM, but in the TP policy, the pricing should be defined properly. What should be the cost component? It should not include the non-operating expenses, extraordinary expenses, right? So it should be clearly defined so that a policy can define in the sum. It is not just static definition, but the other department who will have access to the policy, the operation, the ERP department, they will have access to policy and they will effectively implement it. And then overall governance framework throughout the year, how this policy should be implemented based on the definition of the arm's length principle. Now, I was talking about we are talking about the policy, and we are talking about not only the function analysis, not just getting just the confirmation and getting the confirmation that's concluding it. We are talking about understanding the entire governance of the control by performing the end-to-end control over risk analysis, the control matrix. So this is not just function analysis. This is the real control over risk. Now, how we determine control or risk? The first is the capability. We need to, if we talk about routine static policy, the capability is will list down list of people and board seats. These are the people who will perform. But if we talking about the more defensible design, the real control, the policy will talk about these skills, the overall information, the authority metrics, how the system is aligned currently. That is capability. Now, this is the real control over risk, which talks about the capability. Not only capabilities, is there any actual performance? I've listed down that, okay, these are the 5 people who will responsible for the actual capability and they will perform. But unless there is an actual performance and evidences for the actual performance, it is not going to help. Today I can get interviews and the interview is saying that yes, we have persons who are taking decisions here, or we have persons overseas, they are taking decisions here, I'm confirming. But then is there an actual performance? Is there any evidence of logs or system logs where we can find out there's an actual performance? Unless there's a system logs, we are not fulfilling this definition of capability plus actual performance. So that's one angle. The third is very important, financial capacity. Now, this is again very, very important part of the entire arm's length application is do I have the financial capacity? If if I'm saying that my overseas entity will be taking the risk, I'm the low risk entity, whether the overseas entity would be actually having the financial capacity to bear the financial risk if something goes wrong, right? Then only I can say, yes, that entity has a financial capacity, right? So ability to basically standalone ability to absorb the downside. A lot of time we say that in contract that overseas entity will be assuming the risk. But do we have the evidences or something where we can show this that if something goes wrong, the parent entity would be responsible? A lot of time contract is drafted that parent entity is responsible. But when something goes wrong, the parent entity raise hands that let's local entity only bear the risk after 2 years down the line. And that is real lack in the actual application of the arm's length principle. But because at the year end, we take the backward looking approach, we'll take the backward data and do the analysis. Yes, parent entity will bear the risk. But down the line, 2 years, when we really see parent entity is raise their hand that I'm not responsible, let's local entity bear the risk, then it means we are breaching the contract, we are breaching the terms of the conduct also. The information which we have given to the tax authority is not aligned to the actual conduct. This is very, very important and one of the most underrated part when it comes to the transfer pricing. Evidence trail, what are the evidences? Local file narrative, do I have the real decision right maps? We put the organization chart in the local file or TP study. Do I have real decision making maps, live decision making to align those narrative which we have documented in the local file? So this is the whole control over risk, which is very, very important when we look into the function analysis from a holistic perspective, not just getting the confirmation. When should TP policy to be updated? I'm not going to too much of this slide. We have a number of other slides to discuss, but then there are a number of situation scenario where one need to update the TP policy, the new transaction type, business restructuring, mergers and acquisitions. Each scenario, we need to do reverse working. If I'm a taxpayer and some TP adjustment is made by the tax authority, I should not only think about that what changes I should made in the local file next year so that I can avoid this adjustment in the future year or policy. I should also think about apply the reverse engineering and think about what changes I should make in the entire design, in the system, in the ERP, in the policy, in the procedures, in the coordinations, so that I can completely avoid this kind of risk in the future years. So this is not only about the compliance and the audit and just making changes in the TP study. It's also about applying the reverse engineering and putting and designing the system which is more defensible. We have the gold mine available. We have so many rulings available, and we can apply reverse engineering and identify cases where we can design the entire system. we discussed this TP policy issues, that number of cases only benchmarking is there, no delineation is done for the transactions. Contract says something, conduct says something. The policy is just copy pasted from the globally. That also we have observed. There should be alignment. No DMPE analysis is performed for intangibles. Financial transaction just benchmark without even evaluating that is it a loan needed? Is there any substance for the loan, or is just a debt to take the benefit of the interest? A substance is also important when it comes to the financial transaction. So the design of the system should be such that it justify the substance, not only justify the form, but overall the substance, overall process flow, the entire end-to-end design, and then we can make a defensible transfer pricing system. I take couple of examples quickly when it comes to the designing of the TP policy. One example I've already taken in the earlier slides is that the base of the markup, if I'm only a low risk service provider, the markup should be on the cost or not on the markup on the cost of for which I'm adding the value, not on the goods which I'm sourcing if I'm just a low risk service provider. Now, we can design this by applying the reverse engineering, that what my system is into. Am I taking the real cost base for these transactions? Do I have a proper system to design to generate invoices which clearly define these transactions? A lot of cases there are a disconnect between the agreement and the conduct and the invoicing. Invoice does not say anything. The agreement says something else. The ERP, put something else. So this create a issue. Another important example is the aggregation. Now, aggregation is important concept. We can design the system by aggregating a lot of interlinked transactions. Let's say royalty, purchase. These can be purchase of raw material royalty, because I'm manufacturer, I'm paying royalty, and I'm importing raw material for the manufacturing. We can aggregate it. But then in many cases, we don't even think about designing this aggregation. And if we, let's say, the entity is facing the AMP issue, the advertising marketing expense issue, AMP litigation, one can design in such a way that to show the real characterization of the entity. See, all our transactions are interlinked to each other. I'm an entrepreneur in the market. After making payment of the raw material, I'm an entrepreneur, and I have aggregated all transactions to show the overall characterization of the entity, and that needs design from the day one. That, see, the objective is not just to get the comfort of the aggregation and do the transfer pricing analysis. Aggregation should never be done based on the comfort. A lot of cases we say that let's do aggregation separate, not possible, we don't get data. Aggregation should never be done based on the comfort. The aggregation should be done based on the real characterization. What kind of narrative, what kind of actual conduct we want to justify, based on the same aggregation should be done based on the data availability, not just based on the comfort. So again, the design opportunity comes here, that how we want to present our transactions which are based on the actual conduct, and which basically mitigate not only the transaction risk, but also the other risk, let's say AMP and other risks, to justify the overall characterization. There's a design opportunity. Another point is justifying the losses. Now, losses can be challenging to justify before the tax authorities, and there's a significant opportunity to design the system in such a way at the beginning of the year that, let's see, there are losses. What I will do? Losses can be because of the third-party transaction. The first design I will do at the beginning of the year, not wait of the year, that okay, I'll design a segment analysis between the related party and the third party. And when I design, I will get the third party transaction only if it is possible. Segmentation is not possible all the cases where there are both income and expense side transaction, but wherever we have the actual data and where we can allocate maximum cost based on the logical allocation key, we can design the segment. And when we design the segment, it's an opportunity to mitigate the risk from the very beginning of the year, that at the end of the year, we don't need to wait and work on the segment. We can, beginning of the year, create a mechanism in the ERP itself, that this ERP is automated and creating a direct segment. any ERP, let's say S4HANA, there can be internal module can be created where everything is automated and internal segment can be created. That's the one aspect. The another aspect is design aspect is that, okay, I'm into loss, but I'm a low risk entity. I mean, one of the transaction, I'm a low risk entity, right? Sorry, I'm a high risk entity. I'm a manufacturing and supplying. So for the high risk entity, am I getting the right return? I can create a segment. But if I'm a contract manufacturer, uh, I'm manufacturing and other contract manufacturing, I can take tested party, which is a low risk entity, only that transaction, segment level analysis, because I'm a low risk manufacturer. I can take myself, the entity as a tested party, low risk, and creating a transaction by transaction analysis. That way we can design in such a way that we can avoid a loss situation, because losses are due to the overall business operation, not because of that one transaction. In one transaction, I'm a low risk manufacturer, so I'll take the tester party, the local entity. I can also take the foreign entity as a tested party because that entity is a low risk entity. That is again the design system where I can say that, see, locally I'm an entrepreneur. For one of the transaction, the other entity is a low risk entity, and look at that transaction is an arm's length, and losses have nothing to do with that transaction. So again, we have an opportunity to design the system from the very first day that we have a mechanism to take the low risk entity as a tested party rather than here and waiting and see which entity to be taken as a tested party. In a lot of cases, I've seen that evidences are being produced before the tax authority and created at the time of audit. And this is not appropriate. We have a significant opportunity. We have a gold mine in terms of so many rulings available in the public domain. And with those learnings, with the reverse engineering, a system can be designed internally. A conduct and contract can be designed in such a strong way that significant level of work can be avoided the year end, cost can be avoided the year end, and most importantly, risk can be avoided at the time of audit. Again, coming to the AMP and intangible. Now, this has been a significant topic of litigation when it comes to India, and the key argument has been that this is not an international transaction. A lot of courts have or rulings have also appealed this. This is not an international transaction, but then there are other views as well. But on a without prejudice to this, there has been argument made about the characterization of the entity. But as I said, one of the underrated concept which is not being totally used is the MP analysis in the AMP itself. So I was talking about DEMPE in the royalty. In the AMP also one can use the DEMPE analysis. On a without prejudice, look at, this is not a transaction, but on a without prejudice, even if we look at this DEMPE analysis, development, enhancement, maintenance, protection, exploitation, if I have done this, and let's say I'm an entrepreneur in India, I'm one of the largest FMCG companies in India, and I'm doing, I've incurred significant advertisement marketing expenses, and tax authorities have challenged this DEMPE analysis based on, sorry, tax authorities challenge this AMP analysis, AMP expenses based on the comparison to AMP of the other entities, and the difference is said to be a contribution to the brand owned by the entity. On a without prejudice basis, I would do the DEMPE analysis. See, look at the development of the, due to the marketing expense. You look at the enhancement, maintenance, protection, exploitation. Everything is happening in India. So why should I am contributing to the overseas entity, right? So the point I'm making here is that when we talk about the AMP expense, we can design in such a way. So I'm not saying that we should jump straightforwardly saying that, okay, to weaker the point that it is a transaction, we should do the DEMPE analysis. But then on a without prejudice basis, if we look at this concept, this is highly underrated. A design can be created with the DEMPE analysis where I can show with the allocation with the contribution of each of the activities of the marketing, show that, see, even if it is routine, even if it is non-routine, everything is for the benefit of the Indian entity. Nothing is benefiting for the overseas entity, and such kind of adjustment is not warranted. So this is one of the design example. Another design example is a lot of cases, the local file and the master file or the group documents are not aligned. So again, this is an opportunity to design something globally where everything is aligned. Your local file, your master file, your CBCR, all agreements, everything is aligned. See, in fact, just to tell you, in fact, I have alignment is very, very important concept, important aspect in the transfer pricing, standardization of the global facts. And in fact, couple of weeks back, I have sent a recommendation to the OECD to think on a global standard uh, TP disclosure form rather than each country having their own form. Now, this can have challenges, but then this could be a significant thing as a tier 4 along with the tier 3, that why can't we have a one TP disclosure form which can be little bit customized to local entities. But if we have such kind of standardization, this can be a significant benefit, not only from a efficiency perspective, but also from other aspect like MAP, APA's perspective, bilateral APA perspective. This can be significant. So this was a recommendation, just I wanted to share with you. Another aspect of designing is receivables, which is again underrated part. Whenever we talk about the transfer pricing policy, most of the policies you will find that discussing the transactions, and hardly you will find that discussing the receivables, the working capital part in the transfer pricing policy. Now, this is very, very important that this receivable part should not be addressed at the year end. The receivable part should also be considered at the beginning of the year, during the year when the policy is designed, and to think about, is it really trade receivable? Can I mitigate the risk by aligning the working capital adjustment? If it is a trade receivable, what should be the period? If it is a long, long overdue, can it be converted? Can it be converting into form of a loan? We should think about everything while designing the system, designing the policy, and then we can take consider. There's so much of litigation happening, I know, in India on account of receivables, on account of discussing working capital adjustment at the year end. But then we have now the litigation. The taxpayer has an opportunity to design in such a way up that everything, the contract, the invoices, the understanding, everything is agreed in advance. Now, it is not possible all the cases. There might be new transaction, but still during the year can be an opportunity. So receivable also should be part of the transfer pricing policy. This is just one example of pharmaceutical industry, one of the complex industries in India when it comes to the transfer pricing, because a lot of different things in pharmaceutical industry, the branded goods, the the generic goods, and then the research is done in India, and out of research something new coming out, then we need to evaluate who is the owner. Should be the economic owner should be getting the results. Then there would be royalties. A lot of times there's a one royalty, flat royalty for a lot of things. It is very, very important to unbundle the intangibles. That royalty is for what? Is it for process? It is for know-how. It is for brand. And then we should take a decision that is it a trademark royalty, technology royalty? Is it done for something process? So it is very, very important to unbundle that licensing arrangement and understand deeply. There might be an export. In case of pharmaceutical industry, we discussed that segmentation is very important. Adjustment like capacity utilization, adjustment when it comes to the pharmaceutical industry. Intergroup services and AMP, again, we discussed that specifically in intergroup services. OECD has recently come up with the detailed public consultation documents, where even ICI has submitted the paper, and I'm thankful to the ICI for giving me this opportunity where I've contributed. I was one of the contributors where we have contributed. We have basically provided a response to that paper, which is basically talking more about substance, talking more about the economic benefit, and we need to think, because OECD also considering that the future is changing, the businesses are changing. Now we cannot address the challenges of intergroup services with the same traditional transfer pricing mechanism. So hopefully we'll, in couple of weeks or months, hopefully we'll find more advanced, more technically advanced regulations on account of, or guidance on account of intergroup services. We have all discussed in terms of the TP policy, the control, the DAMPE, the characterization, One important part is safe harbor. India has a full of safe harbors now. Safe harbor is not equal to characterization seal. These are just numbers. It is very, very important that we should have a proper control analysis to identify is it IT services, ITS, is it research, it is a KPU, only not just based on the confirmation, but based on the real evidences, control, decision making. So this is the overall end-to-end flow of the TP policy design, delineation of the transactions. Delineation is very, very important. It just should not be just confirmation of the FAR, entire control analysis, risk analysis, entire understanding of the contract conduct, and then we characterize the transactions. Then we select the method. Then we perform the comparability analysis and adjustment. Then putting everything in an internal governance where all the departments will implement it. Pricing governance, how the pricing is defined, what are the cost component, how the markup is defined, codifying the policy, implementing the agreement in defined based in the ERP system, and set the ALP arm's length pricing. So this is the TP policy design framework. Uh, uh, it is not the framework to follow at the year end. It should be the throughout the year exercise continuously. And one more important thing I would like to mention here is that if you read OECD is at a couple of places talking about the forward-looking approach, that when businesses are undergoing a transformation, we cannot rely on the backward looking. Now, this is a drawback in the current transfer pricing, even in local regulation, where most of the regulations are backward looking. We use the data for last 3 years, even latest year data not available. We look for the year and even design the policy. But what about next 2-3 years? The business continuously transforming. Suppose an entity today has 500 employees or 1,000 employees. An entity decides that I will reduce my strength to 500. I'll reduce my strength by 500 people by adopting the artificial intelligence. And next year, is the policy which we are creating is really addressing that forward looking approach? And in fact, for that, there was a research paper on the strategic foresight. I've contributed to the IFBFD, where the policy which we are talking about should be forward looking, not just the year one data. Forward looking, we can foresee that, yes, we know the company is going to reduce the strength. Now, by reducing the strength, how this my policy would change? We know that US is going to impose tariff in next maybe 3-4 months or maybe 1 year on this sector. Is the policy is ready today? That is called strategic foresight and transfer pricing. So this is, again, I'm not covered in this session, strategic foresight in TP. There can be completely different session on this, but this is an important underrated concept when we talk about TP policy, that most of the things are backward looking or for the year under consideration. We should also think about the forward looking, what the plan of the company is, what the plan of global group is, and then we look into the transfer pricing from that perspective. Transfer pricing data management architecture. So this is based on my experience. This is being created. I'll not go into detail, but if we bifurcate, classify the different data into different pillars, there are foundational data, financial data, cost allocation. I'm not saying this is complete, but the point is that when we talk about data, it is not just about the financials or the local file or the benchmarking analysis. That's it. Data related to board minutes, data related to email correspondent, entity structures, organization chart, invoicing, ERP extract, ledgers, true up, true down evidences, valuation report, post audit records, allocation keys, cash pool working. So many things put together, we can create these architectures, and which basically help in reducing the risk. Now, before I'll move on to the operational transfer pricing part, I'll discuss the new Form 48, which is going to be replaced with the Form 3C EB under the new income tax. Now, the point I'm saying is that I'm not going to discuss the contents, these slides from a content perspective, that what Form 48, but more of a substance perspective. So if you look at the Form 3CB, more from an operational TP, that after this Form 48, the TP policy design and the operational TP would gain a significant importance, because the Form 48, which is designed by the government, is basically reverse engineered in terms of whatever the whatever the issues which is faced by the tax authority, or might be taxpayers, or some confusion at the time of audit, some approach is not part of the Form 3CB. Now it is introduced. Everything is reverse engineered, is now part of the Form 48. For example, in Form 3CB, there was no mechanism to mention that we have aggregated following transactions. Now in Form 48, it mechanism is introduced. In Form 3CB, there is a clear bifurcation, clear identification of each type of transaction, intangibles, services, financial, into more detailed breakup. Now it has been introduced. In Form 3CB, there was no mechanism where one can put the cost, free of cost tools are given, any secondment, any subsidies, those are part of the Form 48. It is also covers how each of the methods mechanism is computed, again Form 48. The idea is not to discuss the content. The idea is to discuss more from a substance perspective, that now a lot of transparency would come, and when those so much of transparency mechanism would part of the Form 48, which is auto-populated, there's a lot of opportunity to lot of importance for designing the TP policy, because with this Form 48, when the tax authority is asking so many information in a very structured way, this needs a design which is ready to provide all this information. We cannot wait till the year end and say that, okay, we'll collect this information and put it in the Form 48. We need a design, we need a system which can collect these information at the beginning of the year. And then we can basically, it's not only the information, creating a complete design for the TP policy itself, so that year end there is no surprises, because this form is asking for the information in a very, very structured way, which actually demands for designing the TP policy, right? So we cannot say that distributor is a low risk distributor and we have maintained the policy. We need to give the detail how we have determined that I have applied the TNMM or resale price method. We have to give them the mechanism. So the point of the entire Form 48 versus 3CB is that Form 48 is more detailed, number of additional disclosures, and that is not only from a compliance perspective, from a strategy perspective, a complete design or TP policy is to be required. If we don't follow that, we can still file the correct Form 48, but then this would not be efficient. There may be still transfer pricing risk. At the year end, it would increase the cost. So that was the whole perspective when it comes to the talking about Form 3CB and the Form 48, which is asking for aggregation, asking for the method, computation mechanism, asking for the free of cost detail, asking for the detailed intangibles related treatment, asking for the safe harbor and APA details also. So with this, we have discussed the transfer pricing policy part. Now we will discuss the operational transfer pricing, that how a policy can be implemented in the system. Now, as a consultant, we can recommend, okay, the policy is cost plus 10%. That is our analysis based on the arm's length. But those who are sitting on the industry side, working on the system, it is not always easy to implement that pricing, especially where there are a number of other entities. I give you example, my recent experience, there is a case where there is the largest real estate companies where one of the entities is into managing the entire IT operation of the real estate, a lot of IT cost. Now that IT cost is evaluated, that this is a third party cost, no markup is required, right? And some mechanism is given that this cost can be allocated based on sales ratio, based on number of servers, number of units, number of switches and other things. But when I really gone into the system, it was really challenging to implement that mechanism, because one cost is not giving benefit to all the entities. One cost is giving benefit to only two entities. And there are costs which is bundled cost with the third party vendor. We even don't know which cost is giving benefit to which entity. So there can be such a challenging mechanism where the arm's length analysis may be complete, but implementation can be so much challenging because we don't know the system, how ERP works. In ERP, how cost data is captured. ERP is not prepared as per transfer pricing. ERP is prepared at the organization level, and data is not transformed for as per transfer pricing. So there can be risk. So the point of arms operational transfer pricing is that a lot of cases the uh, the whole process is that we need to extract the data from the ERP. We need to calculate the computation, and then need to approve, then invoice and monitor, and then close. So this is the whole process. Now, this whole process in number of cases can be broken because the ERP, we get the manual data, and manual data is not aligned with the transfer pricing. It includes cost which we don't want. Then we need to manually change those data, and there can be error. Calculation can be approved at a different level and different people, which some people may not have understanding of the transfer pricing. Approval can be delayed, the invoicing can be delayed, so there can be issue in terms of the year-end adjustment. Entire monitoring is required from the end to end. So this is an example of the issues with related to the operational transfer pricing. And this is not only about the process. This is about risk also. If today, if I have given that, okay, your cost allocation should be cost to cost for third party and for markup for the internal prices, I have recommended. But when we really go into internal system, it is not that easy to implement. It needs a system. It needs an automation. Manually can be done, but manually also can be very challenging. So technology plays a very, very important role in this. And specifically when India is introducing Form 48, where there's a lot of work is going to be done, a lot of information is going to be given to the tax authorities, it is very, very important to design a system in such a way that not only the control and the conduct part is managed, but the entire operational part, right from the extraction of the data to the raising of the invoice, needs to be transformed. Now, I'm not saying that each company can afford technology, everything should be automated. Operational transfer pricing is not just about automation and using technology. It's also about using some efficient mechanism, right? Efficient tool, efficient mechanism where one can basically even create Excel workflows. One can create a systematic extraction of the data by creating workflows and systematic use of AI also. And then one can reduce the risk. So it is not always about automating everything. It's about putting efficiency in such a way that there is no gaps in terms of calculation. There's no gap in terms of approval. There's no risk in terms of true up and true down, right? If there's a surprise true up at the beginning, at the end of the year, this may create issue, not only from a transfer pricing perspective, but from a GST and other regulation perspective also. So we need to think from that perspective, from an operational TSP perspective. There can be gap in terms of the markup. There can be gap in terms of the understanding of the cost. There can be gap in terms of credit period that may impact transfer pricing. So this is adjusting is all about the operational transfer pricing. Now, when we talk about the operational TP, there are different kind of scenarios which we observed. One is the completely manual. Everything is managed spreadsheet, no automated. Second is semi-automated. Certain things are semi-automated. Third is the configured, means markup and allocation keys are hard-coded into that. Fourth is control, like everything is control, workflow, proper approval, and have proper locks. And the fifth is the intelligence, which is the which is can be built through the use of artificial intelligence. A dashboard. I'll give you one example of the intelligent dashboard in this session only, a live example that how a data can be accessed or presented in a very in an intelligent way, real-time dashboard. So manual, semi-automated, hard-coded ERP numbers only in the ERP, and then control means all approvals are aligned with each other, and the intelligent system where everything is aligned. Along with that, the insightful detail. Then OTP framework. So I'll not go into too much of detail. There are 5 frameworks basically. First is the data integration, price setting engine, how we integrate the data into ERP, right? So a lot of places. Even ingesting data into ERP can be challenges, or getting the data can be challenging. Price setting engine, there are no engine being formed, even Excel calculations to compute the right TP policy, TP application. As a consultant, I can say, okay, cost plus 10, but there are no engine inside the organization to calculate this. Margin monitoring, it is done at the year end, but throughout the year, it impacts cash flow if you don't monitor, the entire flow, or don't monitor the pricing. Now, this is very, very important. Then the fourth is the adjustment mechanism. Do we have the adjustment mechanism in place, automated, maybe through technology or semi-automated, to ensure that whatever we are adjusting is aligned with the conduct and contract? Now, this way we can overall reduce the overall risk. And then documentation and reporting. So basically, I'll not go into each of this. These are basically 5 pillars of OTP framework that when we think about transfer pricing, we should not only think about the, designing a policy, how we will implement this policy into the 5 pillars. Who are the people responsible for it? Is there any enough engines which are in place to computation of the pricing? Is there efficient engine placed for the raising invoice at the right time? Is there efficient mechanism in place where people can approve the system, right? So these are the 5 pillars. Now I'll not go into each of, we discussed this, but I want to basically go into one of the, this dashboard, which just, so if you look at this, operational transfer pricing dashboard, which is, kind of an intelligent system for the dashboard. This is prepared, taking dummy data, not for any client. If you look at this, there are number of entities in the group, and let's say CFO, which is using this dashboard real time connected with the ERP, that I have the full picture of where my entities are situated, what the entities are doing, which are the basically entities which are profitable, nature of intercompany transactions, entities by characterizations, which entities are distribution, manufacturing, services, intercompany agreements where I have the performance. Look at this system. What I'm trying to say is that the businesses are getting complex. It is very, very important to get the real insights from the data. No, we cannot get real insights from the manual spreadsheet. We need to have a transformative mechanism in place where we can look at the real-time data for all the entities. We filter it out, we get all the data. Not only the data, but also where the red flag is. Now, if you look at the dashboard, there are red flags in few entities where the margin is lower and the conduct is higher, or other way around, where the entities is loss. Not only red flags, but compliance due date also. So the point I'm saying is that transfer pricing needs to be moved away from the passive compliance exercise to the active analysis of the data. And that's where we can evaluate and get the better picture and evaluate the transfer pricing in a more holistic way. And this is one of the pillars that insights about the data is very, very important. Then adjustment mechanism, we already discussed, do we have the right adjustment mechanism? One of the important aspect is level 3 process mapping when we talk about the operational transfer pricing. Now, this is the concept used at the organization level, but in transfer pricing, this concept can be used that every transactions goes through different aspects and there are different stakeholders. So if you see this, start with the ERP and then there are different stakeholders, finance, tax, and the owner approval. A level 3 process mapping can be created for each of the transactions and find out where is the lag, where the data is not getting approved and how much time it is taking, who is responsible for the each transaction. Such detailed map can be created. The level 3 process mapping start from the ERP to the creating the calculation, whether manual, automated, and then sending it for approval. If there are number of approvals, sending everyone, and then drawing this map and finding where is the actually risk exist, not only in terms of the data calculation risk, but also conduct risk, that which entity is performing what or who is responsible for which activity. Now, there is a important concept in organizational metrics called RACI metrics. responsible, accountable, consulted, and informed. Now, this is a very, very important framework when it comes to transfer pricing, because a lot of cases the authority is not defined in the organization, that who is responsible. Is it the operation responsible, or finance responsible, or tax responsible? So this is a framework where one can basically define for each of the transaction that, okay, uh, for the cost pooling, tax team is accountable, finance team is responsible, and IT ERP team is consulted, right? So consulted, and the CFO is informed. So the concept is responsible, accountable, consulted, and informed. If we follow that, we can create a systematic, significant design which can really not only bring significant efficiency in the organization level, but also reduce the compliance risk and also reduce risk at the audit level as well. Now, this is the overall operational transfer pricing policy, and the then operational transfer pricing. So transfer pricing policy is designing based on the conduct of the entity, conduct of the group, and operational transfer pricing is actually implementing that. How we can implement? We can implement through technology, we can implement through this level 3 process mapping understanding gap, and then we can implement through this RACI matrix, where we can create a matrix for each of the organizations. And this is really very important, considering the world is moving from compliance oriented framework to the insight oriented also, where specifically from an Indian perspective, where 3CB is replaced with the Form 48, which is more strategic, I would say, document when it comes to the transfer pricing. A lot of strategic information need to be put into, and that strategic information is should not be generated by just thinking transfer pricing from a compliance perspective. Now, since we have a short of time, what I will do, because we have one more topic to cover, but I'll not cover entire one, just give a high level framework in next 5 minutes, and then we can take up the questions. The third concept of the today's session is the value chain analysis. Now, this concept is mainly used in the most developed countries, but I would not say it is not relevant for India's perspective. In India also, where significant growth happening due to GCCs, due to a lot of startup in AI, a lot of development happening, India is contributing a lot of value when it comes to intangibles. India is also significantly and gradually owning the intangibles, and value chain can be analysis can be a significant. Now, what is value chain analysis is basically not looking a transaction only from a one related party perspective, but looking the entire organization from a one framework perspective. Like if today there is a pharma company in India, I'll not see only related party transaction. I'll see that what is the entire group, which department is creating value, irrespective of related party. There's a R&D department. What is the value driver of R&D? There's a marketing department. There is a clinical trial department. What value it is, now in the value chain analysis, we don't isolate the related party transaction. We look at the entire organization as a whole. We do the function analysis, we do the DMP analysis, but we do from a strategy perspective that, see, you have these 5 departments. Let me understand all the department. Let me understand what your R&D is doing on a holistic perspective, and let understand your value driver, and then based on the value driver percentage, let allocate the profit to that department in the entire group, right? So if India, there is a group of pharmaceutical, India is one of the entities, value chain is performed at a group level, and then when we perform the value chain, we'll say that India is contributing 20% of the R&D. So the share would be 20%. So that allocation should be made to the India perspective. There's some mechanism to compute it. I'll not, because of the lack of time, we can have a separate detailed session on value chain. This is a really, really very important concept. But the point is that this concept is, basically created, designed by the Mr. Porters in 80s, and Mr. Portas has not designed the model based on transfer pricing. It says that any organization can be divided into primary and secondary activities, and primary activities are basically which is contributing to the growth, support activities which is infrastructure. And when we decide this primary and secondary, we identify the value driver of each and activity and allocate the profit. And this is the whole concept of the value chain, that not looking the entire organization in isolation of related party, but look at in the overall framework of the on the group level, and then finally allocating based on the real contribution. In several cases, HMRC has accepted the value chain analysis in a complex value chain, which is where the separate analysis is not possible. Then the tax authorities relied on this value chain analysis based on the real value driver, real contribution of percentage, and allocation based on the DEMPE analysis. So this is all in today's session when it comes to the transfer pricing policy, the operational transfer pricing. Now, what I can do, I can take the questions. I'll go with the first chat box. And the first is, will you be sharing the? I'll be sharing the presentation with the WRC team, and then you will get this. The second is, should not the mapping done in case of Netflix India in their presentation, the formulation TP, and should not be in their boardroom too? So when it comes to mapping done in case of Netflix India in their presentation, in the formulation TP, I'm not very clear about the question. See, this ruling is a favorable ruling by the ITAT. Why it is favorable? Because the taxpayer has maintained a significant level of documentation, produced the documentation before the tax authority, and ITAT, while evaluating, ITAT is the last fact-finding authority, evaluated everything, and after evaluation, it is decided that yes, there are evidences that Indian entity is a low risk entity and everything is documented, and accordingly the adjustment is deleted. Second is, how premix from parent company be treated as a premix formula are available out in the market, are not available out in the market. So I'm again, this is, I'm not very clear. Is it the formula? Is it a question related to any patent for any formula where the local entity, where some formula is created where though no third party comparable exists? If I'm correctly taking this question right, see, there's a concept in transfer pricing called hard to value intangibles. If anything is, there's no comparable exists, still it is an intangible hard to value. And when there is a hard to value intangible, we value the intangible based on the ex ante approach, that today, if I have some intangibles and I have some software where there's no comparable exists, but today I valued that software based on some projections, future profitability. After 5 years down the line, if my projections turn out to be different or way below what is I have given, the adjustment would be there. So we need to understand that just because it is not comparable, it is not intangible. We need to understand that there are concept of available hard to value intangibles. So I think these are only the questions. If there is any other questions, we can take up.
I think one question is there in the question answer box. I hope you got it. That how one should. Will you be able to see that?
Can we, the latest one, right? Can we apply value chain analysis to entity having global branch for same supply of services? Yes, see, value chain analysis can be applied to each and every group of entities. It's not transaction driven, it's a value driven. If the organizations and various entities of organization are putting together a lot of values and they are so much integrated that separate function analysis would not help, we can do the value chain analysis, right? And the objective of the value chain is not to compute the arm's length pricing. Today, I had done one valuation analysis where we have concluded that why are you continuing with this department? It is not adding any value. So it is a strategic decision also, rather than only the transfer pricing, because it's more a strategic decision at a group level, and that's how the valuation analysis is performed.
No, one question is there, like how one should substantiate the designing of ALP during transfer pricing assessment proceedings.
Okay, sorry, I could not see. Okay, so I'll reply. I don't think there's some
Yeah,
issue I cannot see.
just
So the question is how we can design the AMP, right?
ALP during transfer pricing assessment proceeding in the circumstances where the assessing officers are stressing for the
Okay,
comparable
understood.
and
Understood.
are coming with their own comparables. Yeah.
Understood. No, this is a very important aspect and very important question. And I would say that first of all, I would not recommend any designing after the assessment has begin. Lot of evidences are being produced. I'm not saying it is inappropriate, but as far as possible, what we have discussed today, there should be designing as far as possible at the beginning of the year. But in case where assessment happens and still the officer says that this assessment happens and we need to design something, I think such designs should be made, and there's a real opportunity, and which I would say very underrated. A lot of cases it is underrated. Is that when assessment happens, one of the underrated, even assessment in compliance, we don't talk to operation head of the company, we don't talk to R&D head of the company, we don't look into the core intangibles of the company, we don't talk to the CEO CFO of the company. It is very, very important that if we want to design something at the time of assessment, find something real and valuable which the tax authority would acknowledge, which really exists, not creating something new. I'm not recommending to create something new as a evidence, which is not, I would say, appropriate. And I would not, as a transfer pricing professional, I would not recommend it. I would recommend that leverage on what is already there but not visible. Why not visible? Because we don't talk to operation head of the company, we don't talk to R&D head, we don't talk to the marketing head of the company. They can give a real value addition, they can give a real insight which generally missing in the local file, in the transfer pricing documentation, real value addition, real evidences. And that there we can create a real evidence, which is not a creation of the evidence post audit, which is really the providing something which was invisible and we made it visible.
Yeah, I think now the question is over now. It was really a fantastic session, Ajit. You have taken in detail and with the examples and case studies, which I'm sure that it will be helpful to the participant to understand in a better way about arm length pricing and this transfer pricing transactions. So really, from the WIRC and from all the participants, I would like to present a vote of thanks for the session and your timing, that at least you have given your time, you have offered your services for the institute. We are really thankful to you and
Thank you,
looking forward
Swetaji,
for
for the
another interesting sessions in
yeah, thank you very
future.
much. In fact, value chain is again a very interesting concept. It is not yet discussed any time in the Indian TP.
Yes.
We can take up next one. But yeah, thank you very much for this opportunity. It was an honor to it was an honor to present with the WRC and with all participants. It was and if there's any question, anyone, please reach out to me. And thanks again, everyone, the chairman and the vice chairman and all the committee member, and special thanks to Swetaji for this opportunity.
It's a pleasure to have you. I can say that, and with the messages, I can witness that the people are appreciating your session and your presentation. At least one member is asking you to drink some water because आपने पूरा session एकदम एक flow में लिया है without taking a break. So it's
Yeah, I mean,
really amazing.
yeah, absolutely. I mean, it's being so now after being, getting opportunity with ICI on certificates, courses, and this UAE. It's been kind of a practice to do that. But yeah, I mean, I'm thankful to ICI, to WRC for giving these opportunity to the so that we can bring new perspective in the Indian regulations. One of the important thing is that transfer pricing in a way is a subject of economics. But if you
Correct.
really look at the Indian TP, it's just hidden behind the legal interpretation. So if we think from an economic perspective, so many things can be done from a TP perspective. That's something which is hidden, and I would say more and more new opportunities will come.
Yes, and definitely we'll look forward for another interesting session, and we'll reach out to you definitely.
Thank you, Shwetaji. Thank you very much.
With this, we are concluding this webinar now. Thank you. Thank you so much, all of you, for being with us today and join this webinar. Thank you.
Thank you very much. Thank you.